Hello, everybody, and greetings from Stanford University here in Palo Alto in Silicon Valley. I've been coming here the last year a couple of times to catch up with people and to get a sense of how the innovations that are taking place in AI especially has been evolving. But today I want to wish all of you a very happy new year. And put in my sense of worth in terms of what I think are the most important developments in financial technology and the future of finance, which is what I spend a lot of my time and all of my time thinking about. There are lots of pundits and lots of analysts with a whole range of views, and therefore I'm not going to give you a list of top 10 developments taking place that I think we need to pay attention to, but I'll put my finger on just one, and I call it the digitization of the deposit business. It is an idea that may appear very simple and something that people who are in traditional banking are already very familiar with. Now, it is a development that has been taking place in many different formats already. So the digitization of the deposit account already happens if you have digital access to a bank account through internet banking or through payments and so on. So many banks are already very familiar with the idea of digitization of the deposit business. But something more fundamental is taking place right now that we need to pay attention to. We've already seen what digitization of the deposit account can do to a financial institution. Right here in Silicon Valley, we saw the demise of Silicon Valley Bank, SVB. Actually, it's still around, but in a different format now. But it went into liquidation because of the massive outrun of deposits, precisely because it was digitized. And so those of us who have been digitizing our respective financial institutions should pay attention to and be careful of what you wish for, because the more digital you become, the more vulnerable you'll be to some of the effects of digitization, one of which is a digital bank run. Now, the development that I think will be taking place this year has to do with the confluence of cryptocurrencies with traditional banking. So here's what's happening. The Bank for International Settlement has been guiding financial institutions around the world to digitize their deposit business by tokenizing it and encouraging banks to tokenize their respective deposit accounts. Now, this is very different from the original idea of a central bank digital currency. The central bank digital currency was supposed to be a token that is issued by the central bank and then distributed widely, which conceptually raises the point that if central banks have direct access to the end user, then what is the purpose of having a commercial bank? And at the same time, I think the thinking in the Bank for International Settlements and some of its leading leading regulators that make up its membership has been that central banks should not issue a retail deposit, a retail central bank digital currency, but a wholesale one, which is like a backstop to the tokens that they're going to be asking their respective banks to issue. Now, a few countries are already ready to do that. Their commercial banks have been experimenting with tokenizing the deposit business. And something that I found out was that some of these countries are not even in the developed part of the world, they are in Africa. And in fact, I have a very dear friend, Andre, who's been helping African banks to tokenize their deposit account. So something very, very important is happening there. Now, the unintended consequence of digitizing the deposit business is that the ordinary user of a tokenized deposit platform or the deposit business or deposit service from a traditional bank will become increasingly more familiar with the idea of a tokenized deposit asset that the end user will start thinking interchangeably with cryptocurrencies and the many different cryptocurrencies with utility on them. In other words, they would want to do things with their tokenized deposits. And to the end user, they're going to be agnostic as to the difference between a bank-issued tokenized deposit and a cryptocurrency. And what I see happening will be that increasingly the end user will be putting demands on the utility of these tokenized assets, because you can actually program them to be able to be used in specific situations. And of course, central banks that will be promoting their respective jurisdictions or the commercial banks in their countries to issue these digitized tokens will then use the central bank digital currency as a backstop and to make them interchangeable as well, interoperable between the digital assets or the digital tokens issued by the different commercial banks in the respective countries. Now, when I was explaining this to the commercial banks, and especially the digital banks, the brand new digital banks that are seeking to compete with the commercial banks, when I was discussing this with them, I was trying to say to them that, instead of competing with the traditional incumbent banks on the deposit business in the traditional way, they can actually already start fast forwarding to try and digitize their deposit business and build market share from that digitized idea or a digitized business model. I don't think that many of these digital banks, the new digital banks, understood very much what I was saying. And so what they ended up doing was to try and compete with traditional banks, and I'm talking about digital banks in countries as different, as varied as Singapore, Hong Kong, Malaysia, Philippines, and a few in Africa and the Middle East. That the new digital banks have gone ahead and tried to win market share by offering better rates, and it's basically a price war. A new business model has emerged that digital banks can take advantage of, which they're not thinking of yet, and now is the time to do that. The other unintended consequence of digitized deposit industry is that we will start to see best practices that have been developed in the crypto space finding their way back into traditional banking. So interoperability is one of them. Liquidity is another. Liquidity is an area that is affecting traditional banks in such a very such a fundamental way that they cannot see their traditional deposit business in the same way as they have been in the past anymore, just because it's digitized today. And there are new best practices coming in, interoperability, liquidity, and as well as applications being developed on digital deposits. And we'll start seeing the end user putting increasing demands on their traditional banks to allow them to define how they want to use their digital tokens. And it will also create a new merchant proposition and a different relationship with merchants by enabling merchants to use this digital platform to do marketing, to build their business proposition, and to interact with customers more intimately. And all of this will have an eroding effect on the deposit business in itself, meaning that, to use that phrase, unintended consequence for traditional banks. They think that they are providing their customers with new services and new applications and taking them into the digital world, but it will be so interoperable that increasingly there will be less difference between traditional banks and a whole range of new service providers who can make use of these digital tokens that are issued out of the deposit account of traditional banks. Now, tokenizing the deposit account is not the same as a stable coin. A stable coin has to have an asset backing, and a balance sheet, an accounting treatment, and then it's also traded. So therefore, it's never at parity, supply and demand. The traditional bank deposits are only as good as there is bank deposits. In other words, if you have $1 in the bank, they tokenize that dollar, and that's all you get. And it's not traded, but it's a utility token to pay for your bills to merchants that will accept these bank tokens. And the central banks mandating that all of these tokens issued by different banks in their respective jurisdictions will always be interoperable. Long-term consequence of this is that as people become familiar with the idea of a digitized token, they will become very comfortable with a whole range of applications in the crypto space. And that's where the decentralization of finance will start to kick in. And the rules for dealing with digitized business is going to be totally different, are going to be very different from the rules that traditional banks have been accustomed to. So those are my points as we start this year. And I've only had one point, and I put my finger on that. Everything else that is happening in financial technology, fintech, is driven more by hype and a desire to attract venture capital, the use of phraseology that is sometimes meaningless, phrases like financial inclusion and words like that, which I'm a big critic of, because when you look at the substance of what many of the fintech players are doing, they're doing them just to be attractive to venture capitalists. And that also includes the use of artificial intelligence and machine learning in banking. I think a lot of banks, add this phrase to try and demonstrate that they're doing something transformational, but there is nothing transformational in the mere adding of artificial intelligence in what is essentially a traditional distribution business. Banks are also talking a lot about digital assets, and they want to become custodians and trusted, repositories for digital assets. They're very serious in building the infrastructure, but I think that's a red herring that will go away in 3 to 5 years' time. The substance of it is that today the whole idea of digital assets and the custodian services for digital assets is so universal that any number of players can provide this as a service. It's not something that traditional banks will have a monopoly over, or that it will be regulated in such a way that they have an advantage over non-bank digital asset players. There are hundreds of propositions around the world, and the success of even digital assets is in the utility of the digital assets. In other words, it's not in the fact that they can be stored and kept in a secure manner, or that they have an inherent value that needs to be protected. It's in the idea that they have a utility. So those are my points as I start this year. So once again, greetings from Stanford University, and wish you all very well. It's already evening, but it's a nice, warm, balmy evening, although it's in the middle of winter, and I wish you all well.